Good morning, everyone. You are watching live Daily Market Outlook from Windsor Brokers for Wednesday, 9th of January 2013. And not much action seen in the markets in the past 24 hours, but single currency remains under pressure as the pair holds below 131 during the late American and the Asian session, moving within the narrow range and the sideways mode between approximately 130.55 and the 130.80 on the upside, with pressure still seen towards the downside. Yesterday's comments and the rumors about further downgrade of France pushed basically the single currency lower of its highs posted yesterday at approximately 131.38 level, with more pressure again seen towards the downside, as Eurozone weakness is still in play and shows no signals of any improvement, and the end of crisis is still far from the end. Unemployment yesterday reached record high of 11.8 in November, as European Commission reported, and also the data showed an increase in youth unemployment to 24.4%. This proves that the crisis in the area is still far from over, despite recent opinions to the contrary, including the European Commission head Jose Manuel Barroso, hopefully in the hopeful declaration released yesterday. Comments also from Eurozone about latest wave of optimism among Eurozone consumers and businesses suggest that with more fiscal austerity in the pipeline, the debt crisis is still unresolved, and the unemployment rising and hitting the fresh record high, as we said, 11.8%. Consumers and hence businesses still have plenty to worry about the future and the time that comes. Despite the recent improvement, Eurozone economic sentiment remains in the recession territory. The other currencies, brief outlook: the sterling holds under pressure, remains under pressure and holding below 161. Some dollar buyers against yen found a good opportunity under 87.00 as fresh longs on the pair look for a further recovery. Yes, the pair bounced above 87.60 something was the recent high posted at the beginning of European session, seeing again more potential towards the downside, and basically we need to see the clearance of 88 in order to confirm that the nature of the current recent pullback was corrective, and the Paris will be back in the track of recent bulls. Of course, the Japanese government from the other side is doing their best to stabilize the yen, with yesterday's announcement of buying ESM bonds being one of the steps. Dollar Swiss steady above 92.00, but still lacking strength and momentum for some stronger recovery as a part of bounce from a 90.80 double bottom, with the 93.00 still being intact, and 93 zone acts as a quite good resistance, with the break above there seen as a trigger for some stronger recovery. This is also the main bear trend line. Commodities more or less remain flat during the past 24 hours, but oil's tone is still aligned towards the upside, despite yesterday's renewed attempt at 93.80 and the failure. Still the tone is skewed towards the upper barriers and sees potential for further extension higher, as long as important support at 91.50 stays intact. Also gold ticked higher and broke initial barrier at 16.62, currently at 16.65, seeing again more potential as the price lifts above 55 days moving average. From today's calendar, brief look before we go to the detailed technicals. The data from Australia released during the night. New home sales for November came at 4.7, much better than the October's 3.4%, while monthly retail sales for November dipped by 0.1% compared to flat in the month of October, and the 0.3% increase seen as the forecast. Trade balance from UK is due at the 9:30 GMT. contraction of the dip of the narrowing the gap, basically. Sorry for mixing of the words. Narrowing gap to 9 billion British pounds is seen forecasted for today versus the October's trade gap of 9.5 billion British pounds. That looks a bit more optimistic, of course, in case that the release comes along with the expectations, and the final GDP for the fourth quarter for Eurozone comes at 10 o'clock GMT, minus 0.1%, no change from the third quarter release. Again, another signal showing that European Union is still deep in the crisis, and a lot of work is required for some stronger improvement, and still a long time ahead of us to come out of the crisis. As we said at the comment at the beginning, that crisis is still far from over. From Germany at 11 o'clock, industrial production for November expectations show 1.1 increase, 1.1% increase compared to minus 2.6% that was released in the month of October, another improvement. And from across the ocean, Canadian housing starts for December are due at 13:15 GMT, a slight improvement, 198,000 units forecasted for today compared to 196 units in the month of November. And finally, the crude oil inventories for the week, for the past week, with the forecast. I do apologize again that there is a problem with the, we don't show the forecast if we have it on the other source. 0.9 million barrels build is forecasted for today compared to 11.1 million draw seen in the last Friday's release. Remember, there was due to the holidays, the crude oil inventories release has been postponed to last Friday. Minus 11.1 million barrels was the release, and the minus build of approximately 1 million is forecasted for today. And finally, at the end of the day, late in the evening, trade balance from New Zealand for November showing the narrowing, slightly narrowing, trading up to 670 million dollars compared to gap of 718 million dollars in the month of October. And that was all from the economic indicators. Of course, we have to mention that a release of data from European Central Bank and the Bank of England, the interest rate decision that is due tomorrow, is are two the key events of this week, and more focus is seen towards these events. That's one of the reasons why the markets are not extremely active these days. Most of investors are in the sit and wait mode to see what will be decision mainly from the European Central Bank. And the technical outlook for the majors and commodities, where we're going to have some more detailed look into the technicals, near-term technicals for major currencies and commodities. As shown on the hourly chart, euro is still under pressure. We can see that indicators are pointing lower. MACD is holding below the center line, and the price mainly below the all three moving averages, following yesterday's rejection at 131.38, and basically the push lower based on some fundamentals and rumors keeps the pressure on the downside, as recovery from 130 zone still lacks strength and the momentum for some stronger corrective action, as the pair reverses from 133.00. It's quite a strong resistance, and loses important 131.60 barrier. Now the 4-hour indicators are still in the negative territory, although pointing higher, but again there is a lack of momentum for some more serious action. We can see that 20 days exponential moving average so far caps initially the gains at approximately 130, slightly below 131.00, while the next layer of resistances is at 131.38, 131.25. We have descending 55 days exponential moving average still in the descending mode, and the yesterday's high that keep the upside limited. A break here would provide near-term relief, although we are still not seeing any stronger potential for this, but then we will be facing a 131 50-60 zone. This is the previous range floor. It's a Fibonacci expansion, 38.2% of the uplift from 129.96, and it's approximately 50% retracement of the recent down leg from 133 to down to 130.00. Double Fibonacci and the static resistance previous range floor offer quite good resistance, unless we see the break above here. That will bring near-term bulls back in play. More risk at this point is still seen towards the downside, keeps the downside vulnerable as penetration of 130.55, which is yesterday's low, would again reattract test of interim 130.2015 supports, and the other strong one at 130.00 that would likely open way for further retracement of the uplift from 128.76 to 133.00. Daily structure is under pressure. Loss of initial bullish momentum sees more chance for a further reversal of the larger 126.60 to 133.00 ascent, with the good support, the trendline support standing at approximately 130.20. This is the trend line, bull trend line drawn of 126.60, and then we have the recent low at 130.00, accompanied with the close to it 50% retracement and the sideways moving 55 days moving average that offers a good support zone at 130.00 and 129.80, and penetration of these levels could be quite risky for the single currency, as this would be trigger for a further reversal and further retracement of the larger 126.60 to 133.00 ascent. As said, the indicators loss of momentum, and MACD now pointing and attempting towards the midline, see more potential towards the downside. Of course, we need to see the break of initial moving average of 55 days below which comes 129.61, the 90 days one, and then we have the main bull trend line at 129.60. This is the bull trend line drawn off the yearly low of 2012 at 120.42. So basically quite strong supports: 130.00, 129.80, 129.60, with the near-term structure aligned towards the downside and keeping the downside vulnerable for now, unless we see the break above 131.38 as initial, and a more significant 131.50-60 that will open way for a stronger recovery and expose 131.80, 61.8% retracement, and 132.00 is round figure resistance that will revive near-term bulls and refocus upper strong barrier at 133.00. The British pound is under pressure. Brief recovery of 160 zone stalled at 161.26, despite we mentioned yesterday regaining and closing above 161.00. Subsequent weakness, as better shown on the hourly chart, dipped as low as 160.28, approaching again supports 160.20 and 160.08, with the price holding below the moving averages and indicators on hourly chart being in the negative territory. 4-hour structure also maintains a negative tone, with the 20 days along with 10 days moving averages now capping the upside at 160.70 approximately, with the larger larger moving average of 55 days standing at 161.21, along with the previous high at 161.26, offering a solid barrier that is expected to cap any stronger bounce higher, as the pair dipped sharply from a recent peak of last week at 163.80, sidelining immediate bulls that rallied from 158.26 and cleared the previous barrier at 163.00 to peak at 163.80, and subsequent strong and sharp reversal now threatens for further retracement. Over 61.8% so far been retraced on a dip to 160.08. with the next level seen in case of break lower at approximately 159.60. That marks 76.4% Fibonacci retracement, and this is also the low of 28th of November, ahead of 159.00 round figure and the 200 days moving average that are seen in the near term outlook. As we see, the daily MACD is now breaking below, and the momentum is well in the negative territory, building up the bearish momentum for possible further extension lower. On dollar yen, the buyers found a good opportunity at 86.80. This was the low of the overnight, as the pair on its reversal, broke below 87.00 as our next. That was our next target. Let's just take a look on the Fibonacci levels to see it more clear. Okay. Reversal from 88.40 peak of last Friday, dipped as low as 86.80, just ahead of support, strong support 86.75, low of 3rd of January, and 86.69, 61.8% retracement of 85.64 to 88.40 as sent, clearing our initial strong supports 87.35, 38.2% and the previous high, as well as 50% at 87, with the dips being held above 86, 75, 69 supports. Buyers returned into play. This was basically the dips were contained by ascending 4-hour chart 55 days exponential moving average, where the buyers found a good position for fresh longs, and the initial leg higher reached 87.54, followed by overnight's consolidation, and now we are facing the strong rally of the dollar yen that is now looking for test of our immediate barrier, and basically the important and break point at 88.00. If we see a clear break above 88, then we can talk about confirmation of the higher low at 86.80 as a part of the larger uptrend, and refocus upper barrier at 88.40. That will open way for a possible further extension higher. Near-term structure, as we said, the hourly structure is turning positive now. MACD is breaking above its midline, and the fresh momentum is seen building up. RSI is pointing higher as the price broke above initial barrier at the dynamic barrier of 55 days exponential moving average, with the 10 days one crossing above 20 days and now attempting at 55 days. That gives that supports the current scenario. The 4-hour structure shows the price breaking above 20 days exponential moving average, with the indicators now starting to point higher. Descending MACD following the reversal is now starting to point higher. RSI is already above the 7 days moving average. Momentum 14 is breaking above the moving average. Altogether gives us more hopes for a possible break above 88.00. That will refocus 88.40 and the open way for further extension of the larger rally that so far peaked at 88.40, and looking for extension up towards 90.00 as a round figure, and then 90.40 as 76.4% Fibonacci retracement of the down leg from 94.97 2010 peak down to 75.56 low of 2011. And finally, dollar Swiss. It still holds, as we said at the beginning, holds above 92, a zone where the temporary support was found following pullback of 93.00, with the 93.30 now being seen as a good support of this is the recent lows of the overnight session, and reinforced by 4-hour 20 days exponential moving average. Hourly structure is still in the positive territory. We can see some build up of momentum, and the MACD is in the positive zone, but still rather sideways movements are seen between 92.30 and 92.55, quite a narrow range. the tone in the near-term structure is still aligned slightly towards the upside, and I would say more potential is still seen for some stronger recovery, but larger picture bears are still firmly in play, and unless we see the break above main bear trend line that currently stands at 92.80 and the 93.00 previous high, reinforced by 55 days moving average currently at 93.00. Altogether, break above these levels is required to signal current base and the double bottom at 90.81 and open way for some stronger recovery in the further retracement of the larger down move from 99.70 2012 low, with the latest down leg seen from high of 13th of November at 95.11 with the retracement levels 93 marks approximately 50% of the rally, and seen as a good break point. Break above 93, I would say 93.50 will give us more opportunity for some stronger corrective action. Otherwise, the likely scenario would be further weakness as we are in the downtrend. Unless we break clearly 93.00, then a possibility of fresh weakness and possible attack at 92.00 as initial, and 91.90.80 could be quite a likely near-term scenario. And finally, the commodities. Let's take a look at the crude oil. Remains positive, although in the sideways movements, but studies are hourly structure is in the neutral mode at this point, but 4-hour indicators are still holding a positive tone despite yesterday's renewed attempt and failure at 93.80 recent previous high. Still seeing a potential for some stronger action higher as a part of the larger recovery from 84.05 low of 7th of November 2012, and we are just short of 94.00 as a round figure, and 94.35 61.8% retracement. The positive tone seen on the daily chart despite approaching overbought territory still sees room for a possible extension higher of the recent recovery. There is a good barrier at 93.60 and the 93.80. These the previous congestion tops of September and October that is now been cracked on a spike to 93.83, but still lacking a clear break here. If we see the clear break above this level, I would say 94.35, 61.8% retracement, then we will be looking for a possible stretch towards psychological $100 per barrel, as long as, of course, 200 days moving average currently at 91.40 and the recent lows that were contained by 200 days moving average stay intact. Otherwise, more risk will be seen towards the downside, but the near-term structure is still positive. Immediate supports 92.66, 92.40 and 91.50 as the key near-term support. Also the range floor break of 91.50 could be quite risky for the near-term price action, while of course penetration through 93.60, 93.80 is to open way for a fresh extension of the larger uptrend from 84.05 and 85.20, and look for test of 94.00 and the 94.35 Fibonacci resistance. And finally, the yellow metal improvement is seen. We mentioned yesterday that there is still potential for some stronger recovery as the gold price found support at 16.42, and I mentioned that 1662 acts as the initial barrier. Now we see the penetration through this level that looks set scope for a possible further recovery. Immediate barrier, we have quite strong barrier at this zone. This is the 61.8% Fibonacci retracement, and it's approximately 1690, 1675. We have the 61.8% Fibonacci. We are not talking about expansion, so just ignore the latest one. 1668 acts as a quite good resistance. 61.8% Fibonacci retracement of the down leg from 1694 down to 1625, and break above this would confirm the higher low at 1642, and probably open way towards Fibonacci next Fibonacci barrier at 1678, that is 76.4% retracement, and of course we have the previous peak at 1694 and the 1700 as around the figure resistance. Before this there is a trend line, bear trend line resistance at 1680. So basically a clearance of initial 1668 will open next barrier at 1680, 76.4% retracement, and the bear trend line. However, we have to be aware that the pair is still traveling in the third wave of the larger down move from 1795 yearly peak of 2012, with the lower top seen at 1752 at the end of November 2012, with the fresh low reached a couple of days ago at 1625, meeting our target of 100% Fibonacci expansion at 1628, still seeing the downside, the downtrend intact. However, regain of 200 days moving average that currently stands at 1661 approximately, with today's close above this level would see potential for some stronger recovery that will avert immediate downside risk, and probably look for extension up towards 1694 and the 1700 barriers. And that was all from my side. Please, if you have anything to ask, any question, any suggestion, you can submit them now, and I'll be glad to answer. We have a question about euro yen. Let me just put the chart and see where we are standing. Basically, the euro remains well supported against Japanese yen, as shown on the 4-hour chart, holding just off the recent peak at 115.97 as a part of the larger rally that retraced quite a good part of the broader downtrend from 123.31. This is the peak of 2011 that dipped to 94.10 in 2012, in July 2012, and retraced nearly 76.4 of this rally, with the important break above important barriers at 111.40 and 111.50, extending a dramatical rally higher, seeing more potential towards the upside. Back to the lower time frames, current movements, I would say, are still seen as consolidative, with the 23.6 Fibonacci retracement of the initial rally uplift from 105.96 to 115.97, so far containing dips. Approximately there is also the ascending 55 days exponential moving average. This is at approximately 113.50 zone, keeping the more focus despite descending MACD that on 4-hour chart briefly broke below the midline, but now is returning up. Fresh momentum is still seen building up on the 4-hour chart, still keeping probabilities of possible further recovery as the price broke above 20 days exponential moving average at 114.52. We have immediate barriers at 115.20 and 115.50 ahead of important 115.97. I would say at this point more prospect is seen towards the upside as the recent rally improves also the hourly structure and keeps possible fresh attack higher in play. Caution is seen with the quite extended overbought daily studies that could be signal for some stronger recovery. So far, as we said, It looks more like a consolidation rather than correction, but at this point further corrective action cannot be ruled out. With the levels to watch in case we lose important support at 113.60. It's quite far for this, so we'll take up like from 131 approximately. We have 112.30 and 110.60, let's say, is a good supports, and then 110 is 38.2%. I would say anything below 110 could be quite risky and would signal a much more significant reversal. Otherwise, any dip below 113 should be contained somewhere above 110 to keep the immediate bulls in play. Do we have any further questions, please? No more for today. If not, we'll conclude the session. Our Arabic one starts in a couple of minutes. I would like to thank you for being with us and expect to see you again tomorrow at the same time at 8 o'clock GMT, 10 o'clock local Cyprus time. Whoever, for those that missed the session or connected later, shortly this session will be loaded in the YouTube. Our page is called Windsor Brokers Forex, where you can find a variety of technical analysis reports. Wish you a nice day and very successful and profitable trading, and expect to see you again tomorrow. Good luck.